Welcome back to the Hunter of Dividends YouTube channel. I hope everybody's having a great 4th of July. If you're watching this near the 4th of July, happy 4th to you and your family and friends. Hope everybody's having a good time. And we're trying to get a leg up here on investments for the next week, looking at 3 dividend stocks I think that could be good buys here in the month of July 2022. We'll take a quick look at these 3. I know your time's valuable, so I'm going to try to make this quick. We're going to start off with Store Capital Corporation, ticker symbol STOR. You see its 1-year chart is pretty drastic drop here, all the way down from 37 down to a low of 24.48. We now sit at 26.89 on STOR. Let's take a quick look at this one. 5.73% dividend yield, 0.87% beta. The payout ratio doesn't matter as much for real estate investment trusts, but we're at 70%. And then the shares outstanding have gone up quite a bit, which does stand out a bit to me. Return on equity, 6%. These are definitely tricky to look at and value compared to the average company with REITs, certainly. So a decent amount of debt. They prefer to be above 2. We're sitting at 2.49 on debt for Store Capital. And also the price to AFFO ratio, which is average 15.5, is now 12.1. Remember, it doesn't do any good to do price to earnings for real estate investment trusts. What I do encourage you to do, if you don't already, is own your real estate investment trust in a Roth IRA. These are taxed as ordinary income. Makes a big difference to have these in a Roth IRA versus a regular taxable account. I actually have been buying some more Store, but I've maxed out my Roth IRA dividend for this year, so I won't be able to keep buying Store in that portfolio going forward. I will probably focus more on some of the others, but I do recommend, if you have a chance to put this in an IRA, I think this is a good buy. The last 5-year dividend grows 6%. I think this will continue to grow at about that rate. If we look at this one on fast graphs, this is free cash flow. Historically, this one would be in the range of about $30-some if it traded it where it usually had been trading. If you look at forecasting out the future here, looks like this could be a pretty good rate of return if you go to just the historical averages. 17.6% rate of return through 2024. I imagine you would be really happy with 17.6%. And you got to remember, a dividend yield of 5.73% from a really solid REIT is impressive. I think that Store Capital also has a 70 dividend safety score from Simply Safe Dividends. That's very good rating for REITs. A lot of them are much lower than that. So for such a high yielding stock, definitely a good rating there. I think Store Capital is a good look here. Let's take a look at my second stock, Cummins, ticker symbol CMI. This is one of my bigger portfolio holdings. I think it's top 6 or 8. 2.99% dividend yield. I like this company because it's a mixture of old and new. They're definitely working on the hydrogen technology. This is something where I think Cummins is getting ahead of their competition. They have a pretty solid moat, in my opinion. If you look at the 1-year chart, it's come down a lot from 247 down to 194.11. The 5-year chart, it's actually trading at a pretty similar price as what it did at the beginning of 2018. And there's the max chart here on Yahoo Finance. Let's take a look at Cummins on Simply Safe Dividends here. 98 dividend safety score, which is tremendous. 2.99% dividend yield. And then this is one where the dividend growth has been 7% the last 5 years, 16% in the last 20. Let's see if it looks like it's going to be able to continue paying a higher rate. I do want to point out the forward PE of 10.4 is tremendous. 13.4 is the 5-year average. Industrial's averaging 15.9. I think Cummins is undervalued right now. As far as the earnings payout ratio, 39%, projected to be 31%. The free cash flow here has been a bit noisy. It's been at 55% when it was just 36% the year before. Earnings per share, they do bounce around a little bit here. It's not a straight line, certainly. The free cash flow has bounced around a lot, certainly. And the sales growth has been up and down. This was the COVID year in 2020, so wouldn't read too much into that one. This company, a lot less shares outstanding than what there were a few years ago. I do like that. Return on equity has been solid at 24%. If we look at operating margins, they're sitting a little bit low. Having said that, a lot of the heavy equipment makers do have low operating margins in general. And interest coverage is tremendous. The net debt is very low. They have a tremendous looking balance sheet, in my opinion. So let's take a look at Cummins on fast graphs, see what they think of the valuation of it. We're right defaulted on free cash flow. Averaged out, this would be a rate of return of 28.63% if you got to average by 2024. Operating earnings, again, you would be sitting 21% rate of return, and that does include the dividend. Certainly, great product here from Fast Graphs. I really like the valuation tools. According to sales, not as good of a value here, and if you forecast out, it'd be a flat rate of return. So it depends on how you want to look at this. And forecasting out the EBITDA, which I think is pretty helpful as well, you're in the range of a rate of return of 12%. Any kind of double-digit rate of return, I'm certainly happy to get, especially with a company that has a dividend safety score as high as Cummins. I love that 98 dividend safety score. Really, really good company, very well run. That's my second stock. The third one, ticker symbol LEG, Leggett and Platt. This is a very pretty boring company. You know, it's furniture, couch cushions or couch springs, I should say, things like that. And so the profile of this company is really not exciting, but you know, furnishings, fixtures, appliances, 20,000 employees. So it's certainly a big company. Flooring and textile as well, bedding products. I think Leggett and Platt is being undervalued here as well. If you look at the 1 year, this has dropped from 51 down to a low of 33. 5 year, it's down a decent amount. If you look at the max, overall, it's done pretty well, but it was up in the $27 per share range in 2004. So 5% even dividend yield right now. Very impressive dividend yield. I want to take a look here at Simply Safe Dividends. What do they think of Leggett and Platt here? The dividend safety score is 70. This is one that I really need to up my exposure to. I definitely don't have enough of this. Only 2% right now of my income, and also only 1.3% of my portfolio. The beta of 0.89. Leggett and Platt founded in 1883. So very old company that you're not going to get too many surprises, but a 5% dividend yield when it's averaged 3.63% dividend yield. Also, forward PE was 16.6 on average in the last 5 years. Now we're at 12.8. I like the 60% earnings payout ratio because it's already yielding 5%. So this is a company where I think they can continue to do this. You know, they've raised their dividend consistently. 50 years without a reduction, really impressive. Rare group right there in the dividend king category. So earnings per share, it's been growing a bit here. I think it'll grow slowly going forward. Shares outstanding have stayed about the same, a little bit less than they were, which is good. Return on equity at 26%, operating margins at 11%. The interest coverage is a bit lower than I'd like to see. They have a little bit more debt. So that's definitely a negative on them. Let's look at fast graphs for Leggett and Platt to see what the valuation looks like right now. So this is forecasting. So let's go back to historical. Its average would be right now, it'd be in the 40 some dollars per share range. Instead, this is EBITDA. If we look at operating earnings, it's usually in the range of 18.92, and that would make it in the 50s. If it had a 15 PE, it would be above 40 even. So they do think this one is undervalued. Let's look at sales here really quickly. Sales a bit undervalued again. So let's forecast out, look at the estimates. If estimates are correct, and certainly that's a big assumption. Estimates could come down with the economy shaky. Even if estimates do come down, I think this is a pretty good look here on Leggett and Platt. Even if they come down quite a bit, you're looking at a rate of return of 8.5%, 13.26. Then the average would be up in the range of 17.69. So let's look at earnings here really quickly. Average earnings, if it goes up to the average, it would be 16.18%. I think this is a solid company that's not exciting, but for dividend investors, you're getting 5%, far above anything you could get in a bank account right now, even in a rising rate environment. So I'll take a company that's been able to raise their dividend that many years in a row at this kind of valuation level. So my three stocks to look at to buy here in the month of July, and I will be buying more than this, but I wanted to pick out three for you guys that I like quite a bit: Store, Capital, Cummins, and Leggett and Platt. That's ticker symbol STOR, CMI, and LEG. Leave me a note below. Do you like these stocks? Do you not like these stocks? Why or why not? Certainly appreciate all of you who tune into this. Like seeing this grow gradually here. This is a passion project for me. So let's continue to grow these dividend growth portfolios. It's a lot of fun to see the snowball effect just starting to happen. So look forward to chatting about some more stocks soon. Follow me at Hunt Dividends on Twitter if you don't already. Subscribe, give this a thumbs up. I certainly appreciate it. Everybody have a great week, and we'll see you back soon.